Hello and welcome once again to the 365 Retirement Podcast with the team at Rubino and Lang Wealth Partners. My name is Randy Cook. I'm here with Ryan Marston today as we're talking through some of the issues that you might be thinking about, wondering about, and maybe concerned about and planning through when it comes to your retirement. Ryan, how are you doing today?
I'm doing great. You hit the nail on the head. I think the topic we're about to cover today is concerning for majority of people, Americans in general, never mind those approaching retirement or in retirement.
Well, we always talk about markets and we always talk about income and we always talk about Social Security. These are, at the top of the list for awful lot of people. But taxes is something that we might not think about. As a matter of fact, if you have an advisor, they may be working with your investments, but nobody's saying anything about taxes. Well, That's where Ryan talks about taxes all the time. So that's what we're going to talk about here today. We have actually some advice from 90 years ago. There was a judge, and his name was Learned Hand. Now, that's a handle, boy. Learned? You name your kid Learned? Oh, you better be smart. Okay, so Judge Learned Hand said back in 1935, in America, there are two tax systems, one for the informed and one for the uninformed. But both systems are legal. So when I read that, my takeaway is you should pay as little as you can in taxes, but it's up to you to figure it out. And Ryan, that's really the case, isn't it?
It is. I mean, the tax system's tricky. I don't think a lot of people have too good of a gauge on, your taxes outside of the tax filing deadline every year. April 15th comes and goes, and am I getting a return or am I paying, a check? And people really don't think about how it's going to affect them within their retirement accounts or retirement in general until you're approaching that age. A lot of people don't have a good gauge on it. And the tax system's changed. They changed already. They're slated to change again. So, you got to stay on top of it. And if you read the tax code book, it's a book about this thick. No one's going to do that. And then it's going to change again in 2026. Or it's slated to, I should say. So it's a complex, tricky dynamic. That's a big, big, big part of retirement.
Well, as you say, taxes come out of my check every 2 weeks. I know that. Yeah. I pay taxes when I go to the grocery store when I buy anything. I know that. Sure. I pay taxes on April 15th. I know that. But when I get into retirement, there's these things called RMDs. There's capital gains taxes that I've never dealt with before. My 401k suddenly is something I'm drawing out of and I'm not putting into. And every time I take money out, it's like I have to pay a toll to get my money. There's a lot of different things that you need to know. And I actually saw a pie chart by the people at Lincoln Financial one time, and it said this is where $1 of every retiree's spending goes. 30%, 30 cents of every dollar in retirement goes somehow to taxes. It's your number one expense in retirement. We should have a strategy for it.
Yeah, and it's not just, like you said, income tax. It could be sales tax. There's a variation in taxes, right? If you're saving and contributing to your 401k for 20, 30 years, you're probably not thinking about that balance and exactly what it's going to cost you to start drawing on it. Like when I say cost, I mean tax-wise, right? So you may have $1 million and you think you're going to be comfortable and you're going to draw out $40,000 a year, 4%, every year from the 401k. Well, it's not like it's $40,000 towards expenses that you're going to be drawing out. Oh, the $40,000 of income is taxable. And it's going to be based on the rest of your income you have coming in. Whether it's Social Security, that's going to have a factor. And that's a tricky dynamic because that can be taxed in a multitude of different ways depending on your income level. Or maybe you have a pension that's going to be contributing, as well as Social Security, or pension in lieu of Social Security. Well, that's a factor in what your tax situation is going to look like. Capital gains, interest. We're in a world where we actually have interest again, right? We didn't have it for a long period of time. And, interest and dividends is actually affecting your retirement tax or potential retirement taxes, right? So all those things pool together to create how much tax you're going to owe the government come April 15th or get, you might be getting a return depending on your withholding. So, there's a lot of different ways the tax are going to affect retirement. And like I said, it's going to change, or it's slated to change and sunset back in 2026 to the old levels.
Well, this brings up the idea that, one of our biggest retirement assets, which is our 401ks, our IRAs, they're, as they refer to, as tax infested. We put that money in there. It was before it was taxed. So when we take it out, it becomes taxed. So this brings up the idea of converting some of that money. from a 401k or an IRA over to a Roth and paying those taxes a little bit at a time.
Yep.
So when someone walks through your door and the bulk of their money is in a 401k, what kind of figuring and math and formulas go into that, and who's a good candidate, and how does that all work?
I mean, there's a lot of different considerations when you're going through in considering Roth conversions. One, it depends on your retirement, like retirement age, right? We look at your retirement plan first. We take a look at expenses. We look at your income and see where you stand from that level. If you're going to be comfortable with your current income and you're in a favorable tax bracket, well, maybe we start looking at just throwing the age out there, you retire at 65. Well, maybe we start looking at Roth conversions over a 7 or 8 year period to get money out of your IRA ahead of your RMD age, when the IRS starts to require you to take distributions from any pre-tax assets, because you won't need it, right? So if you can convert a little bit at a time over an 8 year period from IRA to Roth IRA at a favorable tax rate as opposed to the tax rate of what your RMD would be in the future, well, it might make a lot of sense. And a lot of times it will make sense. Certain times it won't, but you won't know if it does until you kind of sit down and go through the exercise, see what your tax situation is now and projected to be over the next 5 or 10 years. And then you go from there.
And the power of that is, if you wanted to buy a car in your retirement years and it's a $30,000 car, you could take $30,000 out instead of having to take $37,000, $38,000, or $40,000 out to get that $30,000. That makes a lot of sense.
It does. I mean, that, $1 million in Roth money, not that, just saying apples to apples, right? $1 million in Roth money is not the same as $1 million in pre-tax assets or IRA, regular IRA money. It's very, very different. That $1 million is yours. Well, depending how much you're taking out, when you're taking it out in the tax code, Uncle Sam has his hand in that pot of the $1 million in the IRA. So if you're taking big withdrawals, you're going to get taxed probably pretty heavily on that, depending on the rest of your income. If you're taking smaller ones, again, it's going to depend on the rest of your income. But everyone's situation is different. If you're taking out big chunks for a big, one-time purchase every 5 years of a new car, that Roth money is, that $30,000 is $30,000. It's a nice feeling.
So you talk about those conversions. Is it necessary to convert the whole block of money, or can you leave a certain amount of it tax deferred and some of it tax free?
I have a handful of clients I work with that we kind of have an idea of what they're going to need age 75 or 73 or 75, depending what your RMD age is, in terms of retirement assets. And we're going to leave a portion of their assets in IRAs because we know the RMD is going to cover and, filter into their expenses to give them the amount of income they need. Well, anything in excess of that, we're trying to convert as much as we can to Roths. It may be that, they want to pay the taxes now and use it later, not worry about taxes, or it just might be to, pass on to their heirs, right? Their heirs inherit the Roth money. They still have to take it over a 10-year period, but that leaving $1 million or $500,000 in Roth money is much more advantageous than leaving $1 million or $500,000 in pre-tax assets, because the pre-tax assets would pass on to your heirs' taxable income as well. So, Roth has a lot of benefits to it. It still has to make sense, but, a lot of times when you retire, you should be sitting down and discussing that with your advisor.
Well, as Ryan said, that tax code is about 75,000 pages or more, and I don't know all of them. I bet you don't either. I bet Ryan doesn't, but he's got access to it all.
I will never pretend to.
But there is a time when you have to check off all the boxes of what you're going to do for retirement and all the planning that goes along with it. And if the box on taxes is not checked off, it should be. And that's going to be a part of every good retirement plan. It certainly is a part of our 365 retirement plan at Rubino and Lang Wealth Partners. You can find us online at 365retirement.com. You can look through the show notes here and find all sorts of different resources that you can use, and certainly set up a time when you can talk to Ryan and the team at Rubino and Lang Wealth Partners. We encourage you to like and subscribe, and we'll see you next week here on the 365 Retirement Podcast.
Ryan Marston and John Conley are investment advisor representatives of Brookstone Wealth Advisors, LLC, a registered investment advisor. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. To find out if Sam Lang is licensed in your state, please call 617-630-8787. Rubino & Lang Wealth Partners is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Rubino & Lang Insurance Agency, LLC, Massachusetts Insurance License number 1783398.